Good evening, guys. Can you hear me properly? Good evening, everybody. This is the first lecture of equity evaluation. Okay. Ready, all of you? Please text me there. Please interact so that I can understand you are there. Akshay says, good evening, ma'am. Mansa says, hi, good evening, ma'am. Okay, where are other people? I can't see other people. Where is Pooja? Where is Harsha? And other girls also, kind of. Let them join. Let them join. We can start the lecture after that. Okay, Virendra has come today. Okay, hi Virendra, how are you? Yes, I know Viru. Okay, yes. Thank you for coming. Thank you for joining us. Okay, so actually I took this English fast track batch because there was a lot of request. But what I understand, that a lot of people are watching recorded actually. If you see the views of the first lecture of bonds, you will see it is almost going to touch like 1,000. Okay, and the number of people who attended were only 20 or 25, something like that. That means I don't know why all are attending recorded mode. They are not attending the live mode. I don't know why. Okay, but maybe like they are able to increase the speed of the lecture and quickly finish it off. That could be the reason, because it's already a bit late. If we talk about examination, it's quite near actually, and we can't take a chance. Okay, but that's good. People are attending. At least they are watching the lectures. Good evening, Pooja. Thank you so much. Chalo, start. Let's start. Okay, will not waste time too much. This topic is relatively easy chapter. Okay, so after this I plan to take foreign exchange. So foreign exchange will again be like 7.5 hours. Okay, so if we could like finish, if you could start our lecture a bit early, maybe instead of 3 lectures of 3 hours, it is better to finish it off in 2 lectures also. You will be able to save a lot of time if we do that. Okay, maybe like see, any which ways, 3.5 hours shouldn't be a problem for you. So maybe if we can start by 6 o'clock or something like that, or maybe something, because exams are very nearby, guys. The earlier I am able to wind up the portion, better it would be for you, all of you, right now. So, okay, so in that batch I was taking 7 to 9:30, quarter to 10. That means 2.5 hour daily, 8 to 10:30, something of that sort. Okay, or 7:30 to 10. That was the timing for that batch. So I now understand that how much time do I need in order to complete the portion. So we did not extend the lecture at all in that batch. That means that time was good enough to finish this sheet, whatever I'm doing, because the same sheet was dealt there also. Correct? We'll discuss that in the later, maybe the, I am fine with whatever you say. Okay. So the name of the topic is equity valuation. Without wasting time, there are three topics in your index of the SFM module. The name of the topics are security analysis, security evaluation, and corporate evaluation. These are the PDF of the today's class. Did I not share with you? Did I not share with you? I'll share with you. Give me a second, please. Give me a second, please. I'll definitely share with you. Can you give me a second, please? Just a moment. I'll immediately share with you. So maybe what I can do now, guys, what I can do, Harsha, say me hi na, say me hi, please. Just say me hi. I can share the PDF for you at this point of time. Later on, I will it will need some time in order to do that. I don't want to disturb the lecture. I create a group for all the people who are in the this batch actually. Okay, so allow me to do that. Give me a second, please. So I add first of all technical. Okay, then and I share the link of the group with all of you. Can I do that? Okay, I'll paste the link there maybe. Okay, group name November 23, 100%, okay, 100% English, okay, fast track, okay, exemption batch, exemption batch. So all the people who are watching this particular batch should try to join here. So maybe now, or what I will do, I will just try to invite you with the help of the link actually. Okay, copy link. Harsha, please say me hi on the WhatsApp. I'll just share with you. You can share with the people whosoever is there, so that I can continue with the lecture. Harsha. Okay, Telegram group. I can do that. I can do that. I can do on the. Are all of you there on the Telegram? All of you are there on the Telegram. I can do that. So I'll share that link. Okay. WhatsApp group link for students attending 100% English fast track. Okay, please join. All of you join please quickly. I'll share the sheet with you. I just forgot. I don't know how come it doesn't happen usually, but today I just missed out on that. Give me a second. It's all done. Good evening, Alekhya. Bharat, good evening. I shared that. So maybe Harsha, would you please ping me on the WhatsApp? She knows my number basically. You don't want to join on WhatsApp? All of you do not want to join on the WhatsApp group because there is a lot of doubt solving. If you want to remain on the Telegram group, that is also fine. I can share the link here. People who want to join can join. People who don't want to join can just. Okay, so I did that. Now you can take a call, whatever you want to do. Fine, start. So what I was trying to say, okay, again, okay, I need to start this whole again. Okay, so today we are going to start the topic called equity valuation in your module, the ICI module. Okay, in the ICI module, okay, they give you 3 chapters. Okay, so guys, please allow me to pick up the lecture a bit, then we can talk. Okay, so that if we keep on talking extra stuff, we will not be able to reach where we want to reach today. So things will be taken care of. Don't worry. Anything that you need, you can text me, not a problem. Now that I have given you the link of the WhatsApp group also. Okay. So if you need something, if you want to ask something, if you have a doubt, you can always ping me there. You can ping me on the Telegram group also. That is not a problem. I will be available till the day of your examination. Okay. So now relax. We can always talk after the lecture is over so that I can concentrate on the lecture and we shouldn't be wasting any time, guys, because this is peak hour of lecture. Okay, so things will be taken care of. Relax. Now what I'm saying is that okay, 3 topics are given to you in the module. Number 1, security analysis, security valuation, and they've also given you corporate valuation. Okay, so combining all the 3 topics, if I do valuation of bond and valuation of equity, the name of the chapters I've changed in the class because they are like pure primary names. You can name them by anything: security analysis, security valuation, this, that, primarily they are valuation of bond, valuation of equity, and valuation of convertibles. Okay, so now in bonds, so they have given all together only. So when they write security valuation, the name of the chapter basically, or the name of the topic, they are talking about equity, they are talking about bond, they are also talking about convertibles. I don't want to deal with all 3 together because each one of them is very huge in terms of and wide and in terms of length and breadth. So if I take all the 3 together, you would feel as if things are not getting over, only on and on. Ma'am is going on, kind of teaching, and she's not just stopping. Okay, so I bifurcate, I just divide the chapters into small pieces so that the students can be relaxed, and the behavior of each one of them is very different, especially the behavior of the equity chapter and the behavior of the bond chapter is very, very different for that matter. So it is easy for me also. Okay, so now we are starting equity valuation. Here I would be dealing with how to compute with the price of the individual stock also, and third chapter, the corporate valuation thing, will also be taken care of here only. So when I'm going to start with free cash flow to the firm method, okay, free cash flow to the firm, that is nothing but corporate valuation actually. So I'm sure you have gotten a good intro, and accordingly we can move ahead. Now, in the first lecture of bonds, I told you the price of any asset is the present value of expected future cash flows. Okay. When I say, this is a very generic definition actually. So the price of any asset, here that any asset is equity, is the present value of expected future cash flows. Here the cash flows would be dividends and actual cash flows of the company actually. Okay, so you can just customize this particular definition into varieties of languages depending on the asset you are talking. For example, when you talk about bond, how do you say? The price or the value of the bond is the present value of expected coupons and the redemption amount. If I talk about a real estate, I would say the price of any asset is the present value of rental income and the price at which I would be able to sell at the day of the maturity, or something like that. Okay, so this is a very generic sentence, so I don't need to tell you more. One very important thing I want to tell here is that there would be different models that we would be using in order to compute the values of the stocks and the companies for that matter. But primarily we are talking about the people who have invested into the company in the form of equity actually. So what are the important features or characteristics that you should know when we are talking about equity? Number one, it does not have a maturity date. It will have a maturity date only when the company buy back its shares or the company closes down. So we do not consider buyback actually. We usually say the equity will be redeemed only when the company closes down. Number one. Number two, the income would never be fixed like a coupon in terms of a bond. It will be always variable. Not that the company does not have money, it has money. It will only kind of announce dividends or provide you with the dividends or give you dividends to the shareholders only if it does not need money for the sake of expansion or capital expenditure. That means to say, if you have money and you are planning to grow your company, you would need, okay. So what is the point of distributing your own money among people and then borrowing the same money or taking money from outside people at a higher cost? So the dividend income can never be consistent. Company might give, might not give, it can give all of it, it might give a part of it, depends. That is the major difference between a bond and a equity. Are you fine, all of you guys? Chalo. Ritika is saying, ma'am, can you share the PDF with markings? Yes, Ritika, I can do that, but I would do that on the WhatsApp group or somewhere like that, okay? Because on the Telegram group, there are a lot of people. I do not know too many people out there, okay? At least, though WhatsApp group also, it's an open group for all of us, so I do not know them also. So I can share, not a problem. I have done for the Hindi people also, not a problem at all. I can do that, okay? Now I read this for you. The value of an equity or a stock is the present value of expected future cash flows discounted at investors' required rate of return. Correct? Okay. In order to compute the value or the intrinsic value should be the value of an equity, we can use various theoretical models suggested by the experts. Mansa is saying, thank you, ma'am. We are fine. Okay. Bless you, Manasa. Don't thank me. Okay. Don't thank me. It's my job. Okay, as required. Thank me when you pass. So just tell me, a text would make me very happy when you pass, or whatever it is. Just text me. That single text will make me very happy. That is the Guru Dakshina that you give to me. Okay, that ma'am, I have passed. Okay, I don't want anything else from you. As required by the model, we would use various parameters relevant to valuation. Okay. Now, the models to be used to study the chapter can be segregated as below. I've given a holistic picture of all the models that we're going to use, guys. So, kind of one is called a discounted approach. I have bifurcated this into two. One is called a dividend discount model. And something, basically this model is used by retail people. For example, I buy 100 stocks of a company or 500 stocks of a company. Am I really bothered how is the company working? Who is the CEO of the company? What are the margins of the company? No, I am just not bothered. I am bothered to the fact that whether the company is giving me dividends, whether the company would be giving me dividends or not, and what price I would be able to sell the stock. That is my only concern. But if I am buying a company in terms of the stakeholding, suppose I buy 10% of stake of a company, would I still be interested in the dividends only. No, if I'm a stakeholder, I would be a part of the management, and if I'm the part of the management, possibly then I am the person who decides how much dividend would be distributed. So dividend would not be of any concern to me. So depending on whether you are a retail investor or you are a wholesale investor or you are a stakeholder, the method that you use to value equity share would be different. Okay, so here dividend discount model, and this is free cash flow to the firm or free cash flow to the equity. Then comparable firms approach. The approach that we use is called PE multiples method basically. That's a better word. Multiples method I can use. Okay, I can call it multiples model. Okay, so when I say multiples model, what multiples are we going to use? PE model, then price to sales model, price to book value model, and many more multiples actually. But primarily you will see that these three multiples are most frequently used. Not that other multiples cannot be created, they can be, but most frequently used multiples are these. Now residual valuation method is EVA and MVA method. I'm not kind of talking much about the models at this point of time, because any which ways we would get opportunity to do that. Net asset method, basically when you are selling a company, you want to liquidate a company, then possibly you see that what is the price that I will get if I sell off the assets, all the assets of this company. So whatever money you get, you will first pay off the outside liabilities, and then whatever is left you will divide among the shareholders. Easy. I have become a machine actually, a teaching machine I feel. Now discounted approach. Okay, dividend discount model. Okay, this model has been suggested by Gordon. Okay, as per this model, the price or the value of the stock should be, guys, you know what, can you hear something? Are you able to hear something, or you are not? If you are not able to hear, then it is very good. Are you able to hear something? Please answer. Are you able to hear something, guys, from outside? Other than my voice, are you able to hear something, some drums or music or something? I'm asking all of you. Yes, ma'am. Because there is a Visarjan actually. You understand Visarjan, the Ganpati Visarjan actually. Little music, yeah. So that is the problem, because kind of daily there would be Visarjan of Ganpati. Okay. So that is going to be a bit of issue, because after 6 o'clock they start. So maybe today is the Visarjan day. So every alternate day there is a Visarjan, like today little bit. Okay, if it is little bit, then it's okay. Okay, it is not, it shouldn't disturb you basically. So now it is written that as per this model, but it will become very hard or harsh with time. So let us say that is why we would need to change the time of the lecture, because you will not be able to hear something. Oh, then it is okay. Then it is okay. So the DDM can be segregated into 3 types of depending on the growth involved within the enterprise. So as per this model, I'll underline that. We'll go very fast today, don't worry. The price or the value of the stock should be the present value of expected future dividends discounted at investors' required rate of return. That means we would need some kind of cash flows and a discounting factor. Okay, so what is that discounting factor? The required rate of return of the investors. For example, looking at the risk, or depending on my risk perception about the company, okay, I can ask for a RE. Why RE? Required rate of return on equity. So you would frequently see something KE, then RE, and then ROR. Okay, so and also ROE. So in a way, these three are same. This is different. This is PAT by net worth. Okay, and K is cost of equity, RE is required rate of return of equity, and ROR is required rate of return. So these three are your discounting factors basically. When when the issuer talks, he would not say return. When the issuer of the equity talks about this rate, he would say cost of equity. When the investor talks, he would say RE, required rate of return on equity, or ROR. Okay. Then what is ROE? ROE is different. ROE is what you invested and what you earned. For example, net worth is what you have invested in the company, okay, and EPS is what you are earning. So PAT by net worth, or you can also say EPS divided by book value per share. You can write either one of them are correct and true actually. So be very, very careful. You will never use an ROE rate to discount your cash flows. It will be like wrong for that matter. Now, they are saying, I am saying basically that now this model that we are discussing is called Gordon model. Okay, Gordon growth model. Okay. Now, depending on the product life cycle of the company, at what product life cycle the company is actually, whether it is a high growth company or it is a mature company or something like that, depending on the kind of growth a company, growth cycle it is into, we can divide this model into three. Number one, no growth model. So what is no growth model? No growth model means, it doesn't mean that if today the company is into no growth model, the company cannot get into high growth model. No, it is not like that. At this point of time, when we are discussing this topic, when we are discussing this company, the company does not have too many profitable opportunities in order to do. It does not have too many projects in their hands. So at this point of time, maybe we can say the company is not having any growth. Okay, whatever it earns, it distributes among the shareholders. Okay, the book value remains constant. Okay, it is quite a possibility that we just kind of wind up our lecture, and the company we were talking about at that point of time might get some book orders of 5,000 crores, and it from no growth model to it shifts into high growth model. That's possible. So no growth model means the company does not have any profitable too many projects at this point of time. Not always. Then constant growth model. What is constant growth model? A constant growth model is a model for a company can be said like, if the company keeps on growing at one single digit rate on a perpetual basis, usually that rate is the GDP growth rate of the economy. Means if your economy is growing at the rate of 5%, 6%, 7%, at least your company should grow by that rate, not less than that. That is called constant growth rate. Okay. Then multiple growth model means, if you remember at all, when the COVID came, there is a company called, there is a company in Pune, Serum Institute. Okay, that was the company which manufactured COVID vaccines for us. The company would have grown by some maybe double digit or triple digit growth rate for certain number of years. Okay, so maybe the company, only when the company, wait a minute. Okay, so only when the, something went into my eye. Okay, so when the company is growing at a high growth rate, maybe it would have some kind of license, it would have some kind of patent copyright, okay, or something that government can say that, okay, for 5 years you can enjoy your monopoly, okay. But after 5 years, you need to share the formula with other, two things will happen. Number one, the company will have to share the formula with the other drug manufacturing companies also, because it is with respect to the society, okay, welfare of the society. Number two, there is a possibility that the other people can break the formula and they start developing. So in either of the case or both cases, the company's growth rate will fall down and stabilize at a particular rate. Okay, so when we say no growth model, how does it look like? Look at this. I'll show you something. Have I given that part? I don't think so. I have not given that part, which you should see. In case if you see, it will be easy for you. For this year, okay, so book value of one share is rupees 100. Okay, then there is ROE is 10%. If ROE is 10%, the EPS has to be rupees 10. Okay, Then suppose I do not have any profitable project. What should I do? Why should I retain money? Distribute all of them. So payout ratio is 100% and hence DPS is equal to rupees 10. Easy. Now this was year 0, maybe year 1. Okay, again this is 100 because you did not save anything here. Okay, you distributed everything. So 10, again this remains constant, again this rupees 10, again the payout ratio remains 100% and again rupees 10. If I draw this on a timeline, if you see 0, 1, 2 and then perpetuity forever. So the cash flows, the dividends, okay, the dividends everywhere, this one will be like 10, 10, 10. So when I'm standing here, when I know this company does not have any profitable projects at this point of time, so it will just keep on earning 10 and distributing rupees 10 till perpetuity. This is assumption I'm making standing at t equal to 0 when I do not have any other information for that matter. Okay. So if you want to discount these cash flows, how would it look like? It would look like 10. Suppose a discounting factor I take as 12%, possible ROR of the equity. Okay. 1.12 plus 10 divided by 1.12 whole square dash 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 10 divided by 1.12 raised to the power infinity. Correct. Now this, when you see this infinity, I don't know how many of you understand that part of the math. This is called a GP series, geometrical progression series. Guys, understand, don't mug up the formulas, it's not a good idea. Okay, so this is the price of any asset is the present value of expected future cash flows. I did that, but how do I solve now? Because I do not know how to go to perpetuity. So this is a, you know, what do you call in mathematics? This is called perpetual non-growing GP series. Perpetual non-growing GP series. When you solve this GP series mathematically, you are going to get P0 is equal to A by R, or you call it D1 by K. That means to say, if any cash flow is going to if any cash flow goes up to, okay, or it can be extrapolated into the future till perpetuity with no growth, then you can compute the present value of all this with the help of that single thing A by R. Guys, did you understand, all of you? So any perpetual cash flow which is not growing, the present value of such a cash flow can be calculated with the help of the formula A by R. Okay, so basically for such kind of cash flows, I say D1 by K. Sorted, all of you? Guys, we need to participate. Boys do not participate in this batch. I don't know why. Are you shy, all of you? Viru will participate. Viru is my student. Viru will participate. He doesn't feel shy with him. But other guys, and then one more, Akshay is also participating. But then I cannot see the names of any other guy actually. All of them are girls. Is it a pure 100% girls batch or something? Understood. Okay, then constant growth model. Okay, start again. So maybe again, can I write here for this one? Can I write like this? Book value, year 0 and year 1. So okay, so here this will be like I just missed out. Book value 100, then again ROE. Look at this. Understand, why do you mug up? Not required. It's such a beautiful subject actually. EPS will be rupees 10. Now in this case, I plan to retain something. I want to, the payout ratio is suppose 40% possible, and retention, we write it with B, retention ratio is 60%. So the dividend will be rupees 4. So how much did you retain? Rupees 6. So this will become 106, again 10%, 10.6, again 40%, again 60%, and this becomes, you know what, 10.6 into 0.4 gives me 4.24. Now if you develop a timeline, I don't have a space actually, I don't have space. Can I do here? I can do here. So if I draw a timeline here, it becomes 0, 1, 2, 3 and perpetuity. So I write here 4. Can I write 4 into 1 point? You know what is the growth rate? You know what is a growth rate? Growth rate formula says G is equal to sustain B into R. What is R? R is nothing but ROE. So whatever you retain and you earn ROE on that, that is your growth rate. Okay, so what is your ROE? What do you retain first of all? You retain 60%, you retain 60%, and into 10% will give you a growth of, why do you have to mug up the formula? It's that simple actually, 6% growth. So all the variables, this is growing at the rate of 6%, this is growing at the rate of 6%, this is growing at the rate of 6%. But that is only possible when your this thing and this thing remains constant across the perpetuity or maturity for that matter. If that changes, then the whole equation also changes. Okay, now, so 1.06, then 4 into 1.06 whole square, then 4 into 1.06 raised to the power 3, okay, and then here 4 into 1.06 perpetuity. Again, can I write 4 by, okay, 4 1.06 divided by 1.12 plus 4 into 1.06 raised to the power 2, 1.12 whole square, and then you know what I write here, plus 4 into 1.06 raised to the power perpetuity by 1.12 raised to the power perpetuity. Again, this kind of equation, if you take this kind of equation, this kind of equation is called, you know what we call this equation? Perpetual growing GP series. Perpetual growing GP series. That means you will keep getting a dividend of rupees 4 with a growth of 6% till the day of perpetuity. When you solve this perpetual growing GP series, that gets converted into this formula. Okay, now this is a constant growth model. Now, I think all of you are good. What do you say? All of you are good? Now, again, going further, multiple growth model. So what does it look like? The multiple growth model looks like this, maybe like this and like this. So it will grow at this, fall, and this is called GS and GC. Then this one, this one, this one. This GS, transition, and GC. That means maybe after that, in my example, after 5 years, the growth rate, suppose the growth rate was 50%. The company was growing at the rate of 50% per annum. Complete monopoly in the market. Okay, but the day the license expired or something happened or the more competition entered, the company's growth rate fell down to 5% till now the company will keep on growing at the rate of 5% till perpetuity. Virender, you are not Viru confused. You are darling not confused. Confused is ICI. Okay, you are not confused. I am not confused. Confused person is ICI. We can't help that part. So the only advice that I can give to all of you is that this model has not been innovated by me or you for that matter. This model has been introduced by Mr. Gordon. He's a very, very famous economist. And he says that the price of any asset is the present value of expected future cash flows and not current or past cash flows. So by any way or means, it cannot be D0, it has to be D1 only because he says it is there in his assumption. Okay, but if the ICI is using D0, D1, we can't help it. We are not wrong, they are wrong. But is there some, is it required that we should be like discussing all this? We already know what it is. So if you get the same question, just copy their answer and get out of it. Knowledge is there, I am happy, you are happy. Don't try to get into unnecessary, and see the probability of getting that wrong answer question in the paper would be low. Maybe one question, maybe at most not more than that. So just relax. Okay, so let's go ahead now. So it is done, guys. But you know what? This is a bit criticized model. Why? If you're growing at the rate of 50%, you can suddenly not grow to at the rate of 5%. It is overnight, it cannot be possible. Correct? So there would be some gradual fall, that is called transition actually. GS stands for supernormal growth rate. GC stands for constant growth rate. If you think you do not know the words, you can just try to understand. Now I have made this sheet so dirty that I am not able to read also. Any which ways, a company has had paid a dividend of 2.50 per share. Okay, and so basically what I understand is this is D0, this is D0, and this is ROR. There is no growth in the dividend. I mean, do you need my help to solve this question, or should I quickly move on? So all the people, now I am seeing that there are people from the North India also, like Gujarat, Maharashtra also, along with the South Indian students, right? So guys, if you are very, very comfortable in English, then stay here in the live batch. Else, I have already taken a Hindi batch, Hindi English mixed batch. And if you see the dashboard, if you go to the dashboard of Khetan Education, if you click live, you'll get all the lectures out there which are recorded in Hindi and English mix. Okay, so you don't need to bear that 100% English part. This is meant for, but if you like it like this, you are most welcome. I am happier because I get more students. I like students in front of me. Do that sum. Yes, no, you can do this sum, no? Maybe I can just discuss this one. Dividend grows at the constant rate of, we don't need to discuss all this in the class. Do you need my help? You have only 1.5 months to the exam. Constant dividend for first 5 years, then grows at the constant rate of 5% per annum in perpetuity. What is it saying? Constant dividend for first 5 years. That means, do you mean to say it is 2.5 only? Yes, it will be 2.5, then grows at the constant rate of 5% per annum in perpetuity. Do you mean to say something of this sort? What have they done here? So they have done, so basically they have taken like this. Do you mean to say like this? Like this, okay? You can do that, but still 0, 1, 2, 3, how many years? 5, 6, until perpetuity. It looks like this. So basically 2.5, 2.5, 2.5, 2.5, 2.5. Okay, this is 2.5 and plus into 1 point. I did not do a good diagram actually, but if you are able to understand, and then 2.5 into 1.05 perpetuity. So basically if you see guys, this sum, in this sum, this question becomes a constant growth model, but not from 1. It becomes a constant growth model from here, this area, right? So what will you do? Very careful. You will come and stand here. You'll come and stand here. Wherever you stand is 0. And this is the first year. So when you do 2.5 into 1.05 raised to the power ke minus gc, suppose you do, what you get is P5. P5. Then this P5, now you discount this here, this here, this here, this here. That is why they have used 2.5 into PVA, because they want to discount all the 5. Okay. And then you discount, look at this. Can you see this? They have discounted this part, P5, this P5 and P5 divided by 1 point, whatever the factor, 1 plus K raised to the power 5. Okay. This is what they have done. This is simple. I think you can manage this question. Should I move ahead, guys? And you know what they have given? See, did you see one very important thing, and something was very important in this question. In this is, I did it very dirty. I want to do it properly. Give me a second, please. So here, okay, here P5 is 2.5 into 1.05 divided by K minus GC, correct? Whatever it is. Now then you PV of P5 will be equal to P5 divided by 1.1 plus K raised to the power 5, correct? You calculated this P5. You calculated using this formula. In the last part of the question, they are saying constant dividend for first 5 years, it is same. Okay, then grows at they are asking you to calculate the terminal value, that is a P5. Okay, but here they have given you that P5 and that is 20. Did you understand the difference between the two sums? In the C part of the question, they are asking you to calculate P5. In D part, they have given you P5. So in the C part, you will calculate using the constant growth model. In the fourth part of the question, you will just discount, because P5 is they have already calculated and given it to you. Okay, great, great. Now the next question. Consider a firm which paid a dividend of 17 per share. This is expected to grow at the rate of 60% per annum for 3 years. Beyond the third year, the growth rate will start falling in a linear fashion so as to become 4% per annum from the 7th year onwards and stay at that level forever. Correct, correct. Okay, find out the intrinsic value of the share if ROR is 20% per annum. Now, this is the transit. They have given, look at the question. This is expected to grow at 60% per annum for the next 3 years. 1, 2, 3. Beyond the third year, the growth rate will start falling in a linear fashion. Okay. So as to become 4% per annum, 4% per annum from the, this is 7th year. This is 8th year. This is 9th year. This is 0. 1, 2, 3, 4, 5 and 6. Okay. So you know what something, what you can do, there are 3 phases. So what we can do is that you will prepare 2 schedules actually. So basically if you see on a timeline, if you see, we cannot use a formula like d1 by ke minus gc. d1 by ke minus gc can only be used when your growth rate becomes constant till perpetuity. Otherwise you cannot use. Here you have multiple variety, the growth rate is not constant basically. It is like 60, then every year it is changing. So what will you do? You will compute the price of the stock in 2 phases actually. One phase will be up to the 6th year. One phase will be up to the 6th year. Okay, here. That means you will discount the cash flows of the 1st year, 2nd year, 3rd year, 4th year, 5th year and 6th year. That schedule would be prepared. What is the D0 now? The D0 is 17 now. So 17 plus 60% becomes your D1. 17 plus 60% plus 60% becomes your D2. 17 plus 60 plus 60 plus 60 becomes your D3. Okay, 17 plus 60 plus 60 plus 60 plus 46 becomes your D4 and so on, so forth. Okay, look at the schedule. Can you see this? Can you see this? Okay, guys, if you see here, the 7th one is also taken. The 7th one is also taken. There are 2 school of thoughts here in this particular variety of question. The first school of thought says, please include the 7th year dividend also in your GS phase, because till the time it got repeated again, how do I know that the constant phase has begun? The second school of thought says that, the moment it hits that constant rate, it means the constant phase has begun. There is a problem because the institute does not clarify that which school of thought they want to follow. If you ask me, ma'am, which one is correct? Both of them are correct. Understand, try to understand and tell me whether you understood this or not. Okay. Now, if I include the 7th year, up to D7 becomes my value in GS, high growth phase. Okay. I discount and I get a value here. Individual discounting of all the cash flows. Then since D7 is already taken, now the next one will be D8 by KE minus GC. D1, if there is a D1, there is a P0. Similarly, if there is a D8, it has to be P7. Okay, you take here and you compute, correct? Now you compute the present value and you compute the price. Believe me, if somebody wants to do at home, please try it out that stop here only. Stop here only. That means only take up to only 6th year and take, instead of D8, take D7. Okay, you will take D7 and P will become P6. Solve the question, take a bet with me, you will get 593.86 only. No change in P0. You know where there will be a problem? The problem will be with this. Because if they ask you to calculate terminal value, then what will happen? You know, in one case you are calculating P6, in one case you are calculating P7. That could be the difference in their solution and our solution, depending on the difference in the assumption actually. Okay, but the final answer will any which ways match. That's a tested stuff you can try out at home. Are you fine, all of you? Please, with every answer you need to tell me you are fine or not. So what did you do? The normal, the company went into the constant growth model from the 8th year. See how fast we are going. Understood, no? Okay, great. I tell all the people, you know, guys, you know, do you know one thing that we do not have female faculties at CA final level, pan India level? Are you aware of that? There's no practical subject female faculty. It's just tough. It is tough. It takes a lot. It takes a lot of struggle, it takes a lot of fight to stand there. Because this subject especially is a male dominated subject. I'm not saying males are bad or something. No, we are not saying that. So all the people sitting out there, you need to, I have worked very hard. I'm an arts graduate. I've done my graduation in political science, I've done my graduation in history, psychology and all that. Okay, because I wanted to do law, but my father did not wanted me to do law because I wanted to become a criminal law. And he was not very much in favor, not at all in favor, not very much, not at all. Okay, so he was not in favor of it. I come from a Marwadi family. Okay, so there he said that yeah, I want you to have a career, but then I also want you to, I want to see you settled in your life. Okay, so if you choose a career of such sort, and see guys, I'm 45 today. I'm not, you are girls, little girls, you know, and just work hard, because you will get little time in comparison to your male counterparts to build your career. Work very hard. No guy in this world, nothing is more beautiful than your career at this point of time, at this age of yours. Girls, all the girls, boys will have to make a career. They will not get married only, their fathers will not give them money. So they shouldn't be, and they have their own challenges. Girls can choose to work, not to work. Okay, they have their own girls, but have their own challenges. But boys are also having their own challenges. They cannot choose. We are in a patriarchal family, so by default it is expected out of a guy to work. There is a different kind of pressure on their head, so we cannot say anybody's life is easy for that matter. But since I am a girl, I can feel that part for the girls. Okay, so girls will get little time, less time in comparison. Okay, just chase your dream, chase your goals, get there and be the best. Okay, don't waste your time, not a moment, not a minute. Okay, just you know, kind of just if you're falling down, just get up, start running again. You're tired, have a glass of water, again start running. You will get there. But you are not going to bow down with any kind of negativity or any kind of thought that I will not be able to do it. But do it faster. Do it faster. Okay, so you can imagine, if I'm an arts graduate, what kind of hard work it would have required on my part to master all these concepts, that too on my own. It took a while. I have read so many books I don't even remember. I'm not saying I've done a great job, but then what is to be done is to be done. This is true for everybody, be it a female or a female or a student, in general for all the kids out there. Okay, just work hard. There is no compromise on the quality of education that you should get. There should be no shortcuts in life. Just run, run, run. You should fall down. You should get up again, okay, and start running again. I know, Pooja, I can see your surname. Okay, start. So little bit of inspiration I think helps, especially this is a very tiring time because you are just ahead. The exams are just in front, standing on doors actually. Okay, so just relax, give your best shot. See, you have to answer yourself. You don't need to answer me or anybody or your parents or anybody. You don't need to answer anybody in this world. A human being is most answerable to himself or herself. You know whether you worked hard or not. Just answer. Keep your conscience clean. Allow your conscience to speak. Don't suppress your conscience, because it will always speak truth. Okay, start. An investor considering to purchase equity shares, okay, of X Limited, whose current market price is 112. Careful. The company is proposing a dividend of 4 for the next year. LX Limited is expected to grow. Again, I need to come again. An investor is considering to purchase equity shares of LX Limited, whose current market price is 112. The company is proposing a dividend of rupees 4 for the next year. So tell me please, this 4 is what, D0 or D1? Please tell me quickly. Thank you, Mansa. Okay, D1. For the next year, okay, LX Limited is expected to grow at the rate of, yes, at the rate of 20% per annum for the next 4 years. Okay, The growth rate will decline linearly to 16% per annum after the first 4 years. Thereafter, it will stabilize at 16% per annum indefinitely. The investors required a rate of return of 20% per annum. Look at this. So guys, the only very important point, all the people who are from Khetan education family, because they have taken classes, so I can tell them, this question is not there in your book, and this is an important question. Mark it as an important. What mistake you are going to do is that you will take 4 as correct, okay, you will not goof up there. Then you will take 4 plus 20%, that will also be correct, but there, can you see that D2, D3 and D4 are 20%? Can you see that? This and this, can you see that? That also, and they said that, did they say something? For 20% at the rate of 4 years, that means the company will grow at the rate of 20%. Do you mean to say that this 4 also is inclusive of 20%? Because if that is not the case, then how come we have 320%? It has to be 4. If they have not taken one more 20%, that only means that this 4 is a D1, and we can back calculate D0 actually, okay. 4 divided by 1.2 will give you 3.33. Yes, be careful there, you can commit mistake there. So maybe I can draw a diagram here. So like this, okay, and again like this and like this, something of that sort, right? So maybe 4 years are 20%. What is it saying? Okay, fine. So maybe they are saying that this is 0, 1, 2, 3 and 4, correct? This is growth. These are growth rates, 20, 20 and 20, and they are saying that will stabilize at 16%. Stabilize at 16% here. This is the stable part, okay, at 16%. Okay. So if you see 20 minus 16, okay, 20 minus 16, okay, divide by how many years? Tell me, how many years? Guys, all of you, how many years? So it has to be 19. How come you get 19? I'll tell you that. 5, 19, okay, then 6, then this is like, what do you say, 18, then 7, okay, this is 17, and this is 8th year, that means to say. So if I take a dot here, this minus this, so 20 minus 16, and this will be 8 minus 4, okay. So again you have to get 20 minus 16 is 4, and 4 divided by 4 will give you 1%. That means, see, you know something, in this whole phase the total fall was 4%, and since I do not know what was the fall every year, it cannot be same. How is it possible? It is not possible. Yes, it is not possible to have 1%. Would you say to your company, okay, it is already 19%, please do not kind of move ahead? You can't say that. But then, because I do not know what was the fall every year, what do? I take a total difference and divide by total number of years, okay, and hence I get 1%. Look at this now. So D5 will be 6.91, okay, plus 19. This is a D5. You get this. Then again D6 will be, again you could have written 8.22 plus 18%, 9.7. Then 9.7 plus 17% will give you 11.35, and 11.35 plus 16%. But I don't know how much they have taken. Okay, guys, look at this. Wait. Look at this. So they have taken up to D7. Which school of thought they are following? I discussed with you 2 school of thoughts. One school of thought says that you should include this 16% in the GS phase, okay, and then you should take, okay, basically D9 and P8, okay, D9 by KE minus GC. But what did they do? They have taken up to only 7th year. Can you not see that? 7th year, okay, that means they are following second school of thought. It is an exam question, yes. second school of thought they are following, wherein they say that the moment company hits the constant growth rate, okay, it has entered into the perpetuity phase actually. So they have taken up to D7, and D8 will be used to compute the terminal value. Look at this, 13.17 divided by KE minus GC. Okay, so you discount your 7, 1, 2, 3, 4, 5, 6, 7 and the terminal value to get the price of the stock. Okay, now and the decision has been given. I don't think it is second school of thought. Yes, very good, very good. Now the next topic, take a deep breath. We are going to start with a new topic, free cash flow approach to the firm. Okay, let's start, guys. So I wish to reach at least half the sheet today. It is required because equity has got many concepts. If we do not cover a good portion today, maybe like tomorrow would be a bit of pressure for us. But it is okay. I am not like bothered about all that. We need to study very properly. Free cash flow approach, the second one. So now what is free cash flow approach? So guys, you know, as I told you that when a company is like, you know, kind of, what do you say? It is wanting, suppose I want to buy a stake in a company. Okay, in that case, I cannot use a dividend discount model, not a good idea, because I want to buy a stake, I would be interested in the profits, in the margins, in the cash flows. How do you calculate those cash flows? The model is said free FCFF. What is FCFF? Free cash flow to the firm approach. Free cash flow to the firm approach, we say. The free cash flow model is based. So what does it say? Listen to me carefully. The free cash flow model assumes that this company, a company is a money generating, cash flow generating machine. Higher the cash flows, higher the valuation. Okay, higher the cash flows, higher the valuation. So what figures would I call as cash flows? Okay, they say that, okay, after meeting all the operational expenses like fixed expenses and kind of variable expenses, everything, that they are called operational expenses, means the expenses that are needed. Okay, the expenses that are needed in order to run the business, they are operational expenses. So sales minus variable cost contribution minus fixed expenses will give you EBDIT. Earnings before depreciation, interest and taxes. Technically we also call that as operating profit. Okay, once I deduct depreciation from EBDIT, okay, I get EBIT, and that is called net operating income. Be very careful, because if it is given operating income, that means depreciation is still there. And if they give you net operating income, depreciation is not there. Okay, you get EBIT. So that means you have deducted all the operational expenses. Okay, when I say firm, I mean to say business. Okay, I also mean to say debt as well as equity, both together. So now what will you do? You will remove tax out of EBIT. You will remove tax. Do you want me to answer, or do you want to question the fact that, ma'am, if interest gives you tax benefit, then why aren't you deducting that interest component from there? Do you want to ask that, or you already know that? Tell me please. Do you want to ask me, or you already know that? Tell me quickly. Anybody knows? Doesn't know. I think you don't know, possibly. No, we do not know. Great, not a problem at all. I expected that because it's a very very intricate logic behind that. Now tell me. I am saying that, Pooja, that EBIT is net operating profit. In order to compute cash flows, what do? EBIT 1 minus T. You remove tax without deducting interest. You can question me, ma'am, interest gives you tax benefit. Why aren't you deducting that? I don't deduct that. Why? I'm asking you, do you know the logic? Why didn't I deduct that? I'll tell you that. So look at this. Now free cash flow, if you see this, I'll be able to make you understand better. Look at this. So basically all the operational expenses means expenses required to run the company, run the business, plus the expenses required to grow the company. Okay, when all these expenses are deducted, what we are left out is free cash flow to the firm. Okay, now the way you did no growth model, okay, the constant growth model, and I'll tell you the logic. Give me some time. If I take you to a certain level and then explain you that, you will understand better. So I remember what I have to speak out. Okay, now, so that means to say EBIT 1 minus T plus depreciation. Why? Because it's a non-cash charge, you add it back. Minus capex. Why? Because I told you all the operational expenses and money required to grow the business. That means if your sales are growing, you need to put some money into capital expenditure. You need to invest some more money into working capital. After deducting all that, if something is left, that is called free cash flow to the firm. Okay, now the way you used no growth model, constant growth model and multiple growth model in the dividend discount model, same models would be used in the free cash flow method also. Okay, the only difference is that in place of D1 dividend, it will be free cash flow FCFF1, okay, by KC. Why not KE? Because in FCFF, the FCFF represents cash for both debt and equity. So if the numerator has got cash for both debt and equity, the denominator must represent both the category of people by default. It must represent both, and hence not KE but KC. So if it is a no growth firm, then it will be FCFF1 by KC. If it is a constant growth firm, it will be FCFF1 by KC minus GC. If it is a multiple growth model, then value in GS and value in GC. But when I say value, okay, so that means you are going to discount free cash flow to the firm, like you discounted like D1, 1 plus KE plus D2 divided by 1 plus KE and so on so forth, correct? Something of that sort you did. Similarly, you are going to do here FCFF 1 by 1 plus KC, okay, then FC, look at them, 1 plus KC whole square, okay, and so on, right? What I want to tell you is that while computing the value, you are going, I'm telling the logic, okay, I'm going to discount this, and it has this one. Correct? No need to mug up. Why do you mug up? Okay, now this has FCFF1 has got EBIT1 minus T now, and you are going to discount with a rate KC. KC has again got what? KE and KD1 minus T. So I'm asking you that if you remove I already from FCFF and then you want to discount, isn't it a double calculation? What you have already removed, how can you discount again? It doesn't have I. So if you want to use KC to discount the numerator should have that element. No. Did you understand what I'm saying? If the numerator does not have I, okay, what will you discount? It is a double discounting then. Once you remove I, then you again discount. Did you understand this? And hence we keep EBIT, we keep interest there only. Because when you discount with 1 plus KC, KC has got KD1 minus T. Okay, so by default it will automatically be discounted. Did you understand that part? Please tell me. Understood. Very good. Understood. Okay. And when you discount these cash flows, you get value of the firm. VOF. Look at this. No growth, constant growth, multiple growth. Don't. I have, many people say, ma'am, you did not teach corporate evaluation. Arey Baba, because the formulas are same now, why should I take it to different chapter? It is not required. It is same model is getting applied everywhere. One place it is D1 and KE, one place it is FCFF and KC, one place it is FCFE and KE, one place it is EVA, MVA and KE. Same model is being replicated again and again. So learn one shot. Why do you want to get into the second chapter, corporate evaluation per se? Correct? Now, so if it is a no growth model, this one. If it is a constant growth model, this one. I don't need to teach, I feel. And then what you get is value of the firm. Okay, then what you get, VOF is like market value of the firm. Deduct market value of the debt, you get market value of the equity. Divide market value of equity or VOE by number of shares, you'll get price per share, and we are done. Let's do one question here. I just want to see what questions I've given here. So one question is this one. This is a very popular question, the institute question, this one. You don't need only such calculations, and I just tell you the adjustments I know you do not know. If you know, still you do not understand. I'll just tell you the adjustments. You can do the calculation part at home. Not required that you should do every calculation here only. Okay. Okay, fine. We have two questions in the category. Let us first finish two questions, then we talk. Now, so here guys, the following details are available with regard to projected operations of Pragati Limited. And it is 1, 2, 3, 4, 5. Sales are given. Sales is given to you. Operating expenses is given to you. So when you deduct 53 from 120, you will get EBDIT. When you deduct 11, you get EBIT. Okay. So for all of them, projections are already given to you. Okay. Now, investment in current assets at the beginning of the year. So that is basically, guys, tell me one thing. Small sums, it will take half an hour for us. It is not the sum is difficult. Basically, what I felt taking these crash courses is that the students know the calculation, but they do not know the logic behind it and the natural flow of the question. And hence they start struggling a lot. So you tell me one thing, suppose your sales was 100, okay, 0, in 0 it was 100, in first year it was like 120, okay, and I say that the working capital requirement will be 10% of the sales. That means 10% of the money is required to keep as a buffer, so to keep the system smooth, because maybe like you want to have more inventory, there would be some debtors and there of something of that sort. Okay, so you need 10% of the sales as working capital. Okay, now, so that means to say the working capital is 10 here, it should be 12 here. So when I tell you, you need to invest, okay, you will be able to start, Prema. No problem would be there. No problem would be there. Because you do not know from where to start. I tell you from where to start. Whenever you have a free cash flow method sum, the first thing that you should look for is a discounting factor. Either they will give you directly or they will ask you to calculate. I'm coming to that. I'm trying to tell you a few things. Second calculation, second working note will be of computation of change in working capital. That is what I was trying to tell you. Look at this. So change in working capital, okay, dash, and here this will be 2. So tell me one thing, when this working capital, whatever, did you not see that? Did you not see that? If you are already doing a sales of 100 and for that you have already invested 10, when you next year you are projecting sales of 120, are you going to put 12 again or 2 only? Tell me please, you need to answer, all of you. If you are having sales of 100 and against that sales, you have a working capital of 10 lakhs possibly, okay? Next year you are projecting sales of 120. Are you going to put 12 again, or you, because this 10 has not gone anywhere, it is in the system only, just for the sake of it is like a lubricant. Okay, tell me please, you will put 12 again, or you need to put only 2 again, because 10 is already there. 2 only. That is called change in working capital. So first thing that you will do is compute KC. That is number 2, compute change in WC. You should first do this, then only the main schedule should start. Otherwise, you will get stuck somewhere. Now look at this. Now coming to the main question. Now look at here. So now guys, what did I do? I need to read the question. Then they've given investment in the current assets at the beginning of the year. Definitely they have already calculated change in working, because at the beginning of the year, you will put only the change component. You will not put the whole component. Who would put like that? Okay. Investment in the fixed assets at the beginning of the year, capex they have already given to you. Okay. Now there is something called post-tax non-operating cash flows, like sale of a plant. Okay, sale of a plant, correct? No. So in that scenario, if they have given post-tax non-operating cash flows, you are supposed to, so after adjusting, sales minus operating expenses will give you EBDIT, minus depreciation will give you EBIT, EBIT minus tax, EBIT 1 minus T, minus change, minus capex, minus add back depreciation, and then okay, minus capex, minus change in working capital. If you do this adjustments, you are going to get, okay, free cash flow from the operational business, means the main business. Okay, to that you will add this non-operational cash flow. They have not mentioned what it is, but for example, like sale of a plant. Okay, so when you do capex, you deduct from the cash flows. Similarly, when you sell that asset, sell that capex, that plant, it has to be added back, but on a post-tax basis, because depending on the salvage value and the book value, you are going to take only the post-tax salvage value of the plant. Actually, I'm not getting into that detail because you will deviate in that case. The company has a long-term debt carrying an interest rate of 12.5% and has some non-interest bearing current liabilities. The cost of equity capital is 16%. KE, KD. The company does not have any other long-term sources of finance. The market value of equity, what is this? This is given to you for WDE. Do you know that KC is, look at this, KC is WD, KD 1 minus T WEKE. So 30 is your debt and 50 is your equity. So this is called D by D plus E. Okay, the D by D plus E is called WD. Okay, they might give you in the question D by E. Suppose I say, I need to explain this. I think you guys are definitely going to goof up in the examination. I need to tell you. I say 0.5. That means WD is 0.5 and WE is 0.5. But if they say D by E is equal to 0.5, what do you mean by that? What do you mean by that? Is it same? No, it is not same. It actually means D by E is equal to 0.5 is to 1. So D by D plus E in that case will be 0.5 by 1.5. Are you fine, all of you guys? Are you good? Could you understand? This is very, very important. So look for the language, whether it is a debt ratio or a debt equity ratio. If it is a debt ratio, that means they have already given D by D plus E. But if it is a debt equity ratio, then you will have to make appropriate adjustments and convert that into debt ratio actually. Correct. So they are different. The operations would be, the calculations would be different. Okay. But here they have given the values, so no problem at all. Okay. Now, correct, no? Now going further, nothing they have done extra. See, sales figure is already given. This is given. You compute, less depreciation, EBIT, you remove tax, add back depreciation, then remove the capex that given in the schedule, remove change in working capital, you get operating FCFF. This word was required. Why? Because there is one more cash flow, non-operating, and plus you get the free cash flow to the firm. This is, so what will you do? FCFF 1, FCFF 2, FCFF 3, 4 and 5 would be discounted separately. And then they say in the question that what they are saying, from the 6th year onwards, look at this language, from the 6th year onwards, the free cash flow of the company is expected to grow at the rate of 8% per annum. That means FCFF5 1 plus GC divided by KC minus GC. You get V0F VOF5. Same guys, the way you did for dividend and value, same you're going to do here also. They did the discounting of FCFF 1, 2, 3, 4, 5 separately, and then FCFF 5. You know something? There is an adjustment. You know what? There is an adjustment. What adjustment is that? VOF 5 is 86.6. Can you see that? Should I take 86.6 to compute the continuing value? Because this 86.6 constitutes 22. Is it a good idea? Because whatever you are going to take to compute the continuing value, you are assuming that it will be there in the future. Is a non-operating cash flow 22 is going to remain in the future perpetually? Can you predict that? Can you predict that? Is it possible? No, and hence I removed that. Look at this. I removed minus 22, and that is how the valuation game happens. You never get to understand. Only if you study properly, you get to understand. Okay. So you remove this, compute the value, discount, and you get the value. And we are done, guys. Correct. Correct, Virender. Correct, Viru, actually. Got it. Correct? Okay, let's go ahead then. This is institute exam question. Can you give me one second, please? Give me a second, please. I'll just come back in 1 second, but it's raining very heavy. I need to see a few things. Okay, start. Any doubt you have till here? Any doubts you have till here, guys, all of you? Okay, I can repeat, Piyush, but which part do you want me to repeat? Piyush, which part do you want me to repeat? Acha, okay, I got it. So, okay, I was trying to tell you is that, see, this one, if you see, this is going to be, extrapolated into the future, this 86.6. So we should not take inside extraordinary profits and extraordinary losses, because you are wanting to use this value to compute the value of the firm. Okay, like as if you're considering the cash flows of a lifetime. So don't you think that from the perspective of valuation, we should take only those cash flows which look like stable in the long term? What do you say? So 22 is a non-operating cash flow. That too, it is coming very alternative here. Is it good to keep there? Piyush, you need to answer me, because if you answer, then only I can proceed further. Okay, good. Fifth question. Following information is available pertaining to ABC Limited, which is expected to grow at a higher rate for 3 years, after which the growth rate will stabilize at a lower level. You did not see one more formula I had given there. You will use the formula depending on the requirement of your sum. Look at this formula I'm talking about. EBIT1, I just rearranged this whole thing. Okay, EBIT1 minus T minus capex minus, you know what? This is called gross. Okay, so this is called gross. Capex is gross. Sorry, capex is gross. Understand? Just imagine that P&L statement in your mind. Okay, how does it go? It goes like it goes like sales minus variable cost is your contribution minus fixed cost will give you EBDIT. Okay, running expenses of the company. Then EBDIT minus depreciation will give you EBIT. Okay, did you not provision for depreciation? You did. Minus depreciation means what? You have provisioned something there, correct? Then you come down and down and down and down. Okay, then you say you paid the tax. You then add back the depreciation, okay, and minus the capex. You know what is the meaning of that? It means that suppose I had a requirement of 100 crore of capex and 80 CR is the depreciation. That means you have already provisioned for 80 CR. You have already provisioned above for 80 CR. Now you need to draw only extra 20 from the system. And that extra 20 is that amount on which tax benefit is not allowed. When you spend money to create new assets, the money that you spend is not allowed to have a tax. They are not tax deductible expense. Agree or not? And hence they would be drawn after the tax, not before that. So depreciation money is like wear and tear and everything. Okay, that 20 CR will be used to create new assets. Okay, and that money, that 20 CR is not allowed to be taken as an expense in the P&L statement. Okay, so basically 100 crore is your gross, okay, and 20 is your net. So when you do capex minus depreciation, okay, from EBIT 1 minus T, you are going to draw only that extra 20, not the whole of it. That is the logic here. Okay, now going again to the schedules. Going again to the schedules. Okay, look at this. So guys, you will get two types of sums. Let me like I don't want to give you a surprise at all. There are two varieties of sums in this category of free cash flow to the firm. The first category is like question number 4, where the projections have been already provided to you. Look at this. This is like you are standing at 0. This is year 1, 2, 3, 4, 5 in the future. The projections have been already given to you. You don't need to apply that growth rate in order to calculate the sales, or for that matter anything else. Okay, the projections are given, and the question gives you the change in working capital. The change in working capital. Okay, this part they have given. They have not given you. Have they given you the total working capital? The way I gave you 10 and 12, have they given in this question 4? Okay, answer me clearly. They have given 10 and 12, or they have given you 2? They have given you 10 and 12, or they have given you 2 in the question. Correct, Mansa. In the question number 4, they have given you 10 and 12, or they have given you 2. Correct. They have given. So please remember, there is a difference, there is a very important distinguishing factor between 4 and 5. Number 1, the first distinguishing factor is that they have given you projections. Yes, they given you projections. Okay, they did not ask you to apply growth rate and calculate. Number 2, they have given you cannot imagine what kind of difference this data can create. Actually, change directly given. Very good. Now in this question, look at this question. In this question, they have given you, what they have given? Revenues 100 crore. Okay, there is some lag. Yeah, could be possible. Everybody is facing a lag. Everybody is facing a lag. Okay, so EBIT, these are the values for 0, 140 and depreciation. Okay, then they have given here some information: growth in the revenue and EBIT 20% in the high growth phase and 10% in the stable. That means this 10% is for that GC phase. Okay, KC minus GC. Okay, then they say growth in the capital expenditure and depreciation. Look at this, 20%. Okay, then they say risk-free rate 10%, equity beta 1, be careful, 1.15, market risk premium 6%. What I think here is that this three data would be used to compute KE. Okay, this is used for KE, this is your KD, and this is your debt equity ratio. That means it will be 1/2 and 1/2. That means you need to calculate, and we also need a tax rate. Actually, working capital is 25% of the revenue all the time. Corporate tax rate is 30%. So tax rate is given to you. The first thing that you should do is to calculate KC, and KC will be equal to, what it will be? It will be, but I need to calculate KE first. So KE will be, guys, 6 into 1.15. Why 6? Because it is risk premium, RM minus RF. Okay, it is not RM, and plus 10 will give you 16.9. Okay, so 1/2 into 16.9 plus 1/2 into 13 and into 1 minus 30%. That will give you KC. The first thing that you should calculate is KC. Okay, so have they done the same? But they would be different because rates are different. The rates in the high growth and the constant phase is different. So did I not do the same thing almost like KE? They have calculated 16.9, that is correct. Then they have given, I have taken 1/2. Yeah, why am I even calculating? 0.169, this 13% will be the answer for here. But you need to calculate again for the stable phase. Okay, guys, are you fine till here? They've given separate sets of data in order to calculate the discounting. The discounting part will be different. How? FC, how many years are there? How many years are there? 3 years. Okay, so you will calculate FCFF1, FCFF2 and FCFF3. FCFF4 divided by KC minus JC. So FCFF1, FCFF2 and FCFF3 would be discounted at the rate of 13%. Okay, and FCFF4 divided by KC2 minus GC. This is KC2. So you get what? You get VOF3. Again, in order to compute the present value of VOF3, you will use KC1. Are you aware of all this? So what I'm wanting to tell you is that, on a timeline, 0, 1, 2 and 3, 4 and perpetuity. Okay, so in this area, in this whole thing, the prevailing rate is 13%, and from here to here it is 12%. Okay, so you will use 12% only to compute the terminal value. Once the terminal value comes here and stand, in order to discount, you'll use the KC1. Correct? Any doubts anybody has? Any doubts anybody has got? Anyone, guys? Anybody has got some doubts? 2 sets. You need to speak out. I would feel comfortable if you speak. Okay, ma'am, we do not have doubt. If you have a doubt, I can explain you. No, ma'am. Okay. So now, guys, revenue. How did they start your calcs? What is the growth rate here? 20%. Okay. So this will be okay. So 20% is the growth rate. How much is your revenue? Have they started from revenue only? Yeah, they have to start from revenue only. So the growth rate in revenue and EBIT is 20%. So 1000 plus 20%. Okay. Okay, I got the point. Okay, 20% plus 20%, 1440, this I get, and plus 20%, I get 1728. Did you not see one thing which is extra actually? They have taken a separate column for computing. They have taken a separate column. They have taken a separate column, this one, which was not taken in the last question. I tell you what is the importance or the importance of this column. This is a very important adjustment here. Now let us compute EBIT. So EBIT is again what, how much? EBIT is 150. They would have applied, guys, apply the growth rates. 150 plus 20% gives me 180. I get this. Plus 20% I get 216. I get this. And plus 20% again I get 259.2. And plus 10% gives me 259. No. 259.2 plus 10% will give me 285.12. Till here there should be no problem at all. Okay, then after EBIT is there, you just remove tax of 30%. How would you do that? 180 minus 30% gives me 126 I got, and plus 20% I get 151.2, plus 20% I get 181.44, and plus 10% would give me 199.5. You should not be having any problem till here. Now whenever you have been provided with a data where the growth rates are required to compute the projection, the way we use 20%, 20%, 20% and 10%, then you will not use the first formula. What you should do, you should use the second formula. Okay, that is capex minus depreciation. Okay, so what is the capex data here? Like capex is 140 and this is 100. So 140 minus 100. 140 minus 100 will give you 40. 40, they have given in the question, 40 plus 20% gives you 48, plus 20% gives you 57.6, and plus 20% gives you 69.2. But there is a dash here. Why? Because they have written somewhere that, look at this, capital expenditure are offset by depreciation in the stable phase. Do you know what is the meaning of this? The meaning is that when would you need more capital expenditure than the provisioned part? When would you need? When your company is growing at a very high growth phase, correct? But when the company goes into the stable phase, okay, or low growth phase, then you you would be able to manage with your depreciation component provision only. You don't need to buy assets because the growth is not enough. Why would you buy assets? And hence the language comes, capital expenditure are offset by depreciation. That means your capex is equal to depreciation. That is why you take a dash here. Then less change in working capital. Look at this here. Do I need to prepare a schedule? Yes, you need to. So sales value, okay, 0, 1, 2, 3 and 4. I took a wrong way. This will be 10,000. Okay, then 10,000 plus 20% will give you 12,000. Okay, then plus 20% will give me 14,400. Careful, plus 20% will, otherwise I wouldn't have written actually. 280 and plus 10% will give you, is it same? Yes, 19,008. I think guys, I took one more extra this thing. How much is the revenue? 1,000. I took 10,000. No, I need to remove 110 everywhere. And this will be 1900.8. Okay, they say 25% is your working capital gross. Okay, so 1000 into 25% will give me 250. Okay, then 1200, do the calculations, plus 20. Okay, 1200 into 25% will give me, what happened, 1200 into 0.25 will give me 300. Okay, then 1440 into 0.25 will give me 360. Okay, then 1728 into 0.25 will give me 432. Okay, and 1900.8 into 25% will give me 475.2. All of you. Okay, then change in working capital dash. Now 300 minus 250 will give me 50. 360 minus 300 will give me 60. Correct. Now 432 minus 360 will give you 72. And 475.2 minus 432 will give me it's 43.2. Okay, I ask you to operate your calci. I ask you to calculate, operate your calci basically. Okay, do you not remember that in the last question, question number 4, what did you do? You applied 1 plus GC on this value to compute your terminal value. Yes or no? You applied 1 plus GC on the last year of free cash flow to compute the terminal value. Do you remember that? Yes. Do you remember that in order to compute the terminal value or the continuing value, what did you do? 40.321 plus GC by, yes. Why did you take one extra column here? You know why? Start your calcs. Start. Okay. 2 times. Okay. 250. Calc 250 plus 20%. 300 plus 20%. 360 plus 20%. 432 plus 10%. 475.2. Correct? No problem at all. Now again, refresh the calc. Again. 50 plus 20%. Do you get 60? Yes. Plus 20%. Do you get 72? Yes. Plus 10%. Do you get 43.2? No. No. That means you can take this column only if they give you gross working capital, because if they have given only change in working capital, you cannot calculate this value. You cannot, because you do not have the data to calculate that. And hence, what do? We just apply 1 plus GC to this value and compute the terminal value. But since in this question, because if you apply plus 10% to this, you won't get 43.2. You won't. It's not possible to get, because the growth rate is falling down. The requirement of working capital should also go down. But this can be only calculated, and this column will be taken only if you can calculate this. No, not that, not that, not that. I'm saying if you do not have this working capital gross amount data, how can you calculate change for this year? You cannot, because if you apply 72 plus 10%, you won't get 43.2. So what do we do then? Just apply 1 plus GC to 43.2 and go ahead. We cannot calculate that, but because they have given you 25% of the revenue, I can calculate the working capital requirement of the terminal year. I can, and hence I take a separate column. We do not have capex because they said that capex would be offset by depreciation in the stable phase. Why? We do not need extra money to build assets. We do not have such kind of growth and sales in the company. Why do you need that? But because the growth rate has fallen down from 20% to 10%. But even if there is a growth in the sales, the working capital requirement would be there. You would not need capex, but a working capital requirement would be there. Correct. You can take that separate column only when you have the data of working capital not as change but gross amount. Correct, correct, correct. So that is why. So when the moment you see a sum and you see, okay, I have the gross amount of working capital required. Like here you had 1000 sales and 25% working capital. So you just applied that and you could calculate the working capital requirement across the years, and you could compute the change by taking a difference from each other. But if they have given you change, you cannot calculate 43.2. How do you do that? You can only calculate up to 72, not beyond that. In that case, what would you do? 40.32, 1 plus GC divided by KC minus GC, khatam. Finish. But if you have, you can go ahead and take one more column. You can calculate that. Correct. So look at this. Third year they have taken, they computed the cash flows. Look at this. 3 years cash flows, they discounted and got the value. And 156, the last value they have taken, FCFF4 divided by KC2 minus GC. And then this is basically VOF3 discounted by 3 years. Get the value, add both of them, and you've gotten the answer. I told you I'm not going to make you calculate and count everything. I'm not going to do that. I will tell you what I know, what you don't know actually. Let's go ahead. Ready, all of you? Guys, what we can do today? Okay, what we can do today, we can do up to here. We can do up to here today, okay, here, till all the models. And then miscellaneous topics we can start tomorrow. So whatever time it takes. Okay, so we will not, so that you can go and focus on studies also. We can keep, any which ways tomorrow we are going to do equity only. We are not going to do something else, right? We can do till here, maybe like, I don't know. I'll see to it, don't worry. I'll see to it. It will not take much time actually tomorrow also, because they are not topics, they are just small things that we need to finish off. Extra questions are given, so it is like manageable quite a lot. Just 15 minutes, Virendra, 15-20 minutes more, and then we can just wind up the lecture only today. You can go and study. It took relatively much lesser time. You can go and study. Tomorrow again we meet at 7 o'clock and again finish in 2.5 hours and just go. I don't want to waste your time because exams are very near. What you can do, guys, if you have doubts now, you can discuss in the WhatsApp group also later on. Not that I'm going somewhere else. So if there is a doubt in terms of understanding, I'll rectify there only. Don't have to worry. Relax. I know you are hungry. I am also hungry. Now, this thing, relative valuation model. We went very fast actually. Okay. Now, what is relative valuation method? I give you one example and you would be sorted after that. Suppose there is a company of mine which is not listed in the market. Okay. But that doesn't mean my company doesn't have value. Okay. So I identify 3 proxy companies. Okay. Which will be used as base. Prerna, if you scroll, somebody will paste for you. Okay. If you scroll upside, maybe like you will see the link, or maybe I can share again. Give me some time. Towards the end of the lecture, I'll share again so that whatever any person wants to join, they can join. Okay, now come back again. So suppose I have a company, my company is not listed. What are we trying to do? Tell me. We are trying to find out the value of the stock of my company. What is the value of my stock? Okay. Now, in that situation, guys, what I will do, I will identify proxies in the market who are similar in terms of size and shape and business and everywhere. They are called proxies. Okay. And I am a company. Suppose there are 3 proxies, A, B and C, who are look alike. They are into the same business and they have same size and they are into the same industry, something of that sort. Then what I do, I compute PE multiple, price to earning multiple of A, price to earning multiple of B, and price to earning multiple of C. I do that. Okay. And then I take an average. It gives me average PE multiple of the industry to which I belong. Okay. Then what I do, I get average PE multiple of the industry to which I belong. I multiply my EPS to that. I get the should be market value of my stock on the basis of PE model. Correct? No? It's that simple. Now, let's talk about the sum. It says XY Limited, a cement manufacturing company, has hired you as a financial consultant of the company. The cement industry has been, guys, the way I took PE multiple. So can I say it is MPS by EPS? But I can also write market value of equity, total value. Okay. And PAT, I can say that also. PAT or net profit. So this is like per share basis, this is like total basis. It depends what the sum provides. Point number 1. Point number 2, it is not important, it is not necessary that I take only earnings as my base. I can take anything like price to sales multiple, price to book value multiple, anything you can take, the numerator. So when you use this model, I can compute the value of my company on the basis of earning, P of A, P of B, P of C, average PE. PS of A, PS of B, PS of C. Okay, average total 3 divided by 3, average PS. Multiply my sales, I get the value of my company on the basis of sales. So now I have 2 values of my company, one on the basis of earning and one on the basis of sales. Can I have 2 values? No, I cannot. Okay, then again take an average. That way. Then they say XY Limited, a cement manufacturing company, has hired you as a financial consultant of the company. The cement industry has been very stable for some time and the cement companies SK and AS are similar in size and have similar product market mix. Use comparable method. So they have given this multiples: market to book value, market to replacement, market to sales, and market to net income. Means price to sales and this is like PS only. Price to sales and price to PE. Okay, and price to book value. And this is one thing extra actually. How does it matter to you? So what do? They take the data. Look at this. So market to book value, 450 by 400. 450 by 400 if you take. Okay, this is this one. Total both of them and take an average. This is the industry average now. Same way you calculate for each one of them. Okay, and what you will do? You will multiply, give me a second, you will multiply the company, my company's book value to this, my company's replacement cost to this, my company's sales to this, and my company's PAT to this. I get how many values? 4 values of my company. Look at this. Do you see? Indicative value 1 250 into this, into this, into this, and then you take an average of all the 4 values, you get 363.31. Is it difficult, guys? So basically you have 3. It is very easy, guys. It's very easy. See, but however so easy it is, you need to know the logic at least. Without logic, you just keep on doing the sums. What is PE model? Why am I using PE model? My company is not listed in the market. What do I do? How do you mean to say my company doesn't have value? It has value. My company has negative profits. So that means, do you mean to say my company does not have value? My company has the value. I cannot use dividend discount model because my profits are negative. If my profits are negative, where is dividend? I cannot use free FCFF because my profits are negative again. So what do I use? I cannot even use this one. I will have to use this 3 because sales cannot be negative. The last topic for the day is a residual valuation model, and that is EVA and MVA. As per the above mentioned model, what is EVA and MVA? So let me tell you. As per EVA and MVA model, the model says that after payment of all this model is different from FCFF method. Okay, this model says that after making payment of all the operational expenses, look at this, and to the stakeholders, whatever is left is called economic value added. Means there is a company who has been successful in meeting all the operational expenses, and it has been successful in meeting the stakeholder requirement also, this part, and still if it is able to generate cash flows, that company calls for some valuation actually. So guys, you know what? D1, FCFF1 and EVA1, what are they? Cash flows. Then value, you calculate P0, you calculate VOF, okay, and you calculate MVA. Can you see that? That means the present value of dividends is called price, present value of free cash flows is called value of the firm, and present value of all the EVAs is called market value added. Now ma'am, what is market value added? Suppose the book value of a company is 100, okay, so no, not that. I will not segregate this. So suppose I can write down rather like this. Market value of a stock of a company can be bifurcated into 2 parts, book value and MVA. How do we compute MVA? Present value of EVAs. That means if the book value of a stock is 150 and it is trading in the market for 200, the extra 50 is market value added. What is market value added? Nothing but the present value of all the EVAs. Guys, is it easy or is it difficult? Again, you need to compute KC here, okay? Because without that, this question cannot be solved. Could you understand all of you? Sabko? I mean, I was about to speak in Hindi actually. Could you understand? Because my, yeah, I have both the languages control, but then yeah, still, everybody please. I'll get busy somewhere then if you don't speak. Clear, ma'am. Okay, so again, look at this. Present value of EVA is called MVA. Okay, no growth model, constant growth model and multiple growth model again. EVA 1 by KC. You will get MVA. Okay, EVA 1 by KC minus GC. You will get again MVA on the basis of constant growth model. EVA 1, kind of if you calculate, if you have D1, D2, D3, D4 and D5 by KC minus GC, correct? Similarly, EVA 1, EVA 2, EVA 3, EVA 4, EVA 5, EVA 6 by KC minus GC and do the discounting. Finish. Look at this. Whatever you get, suppose you get MVA by different models Add this MVA to book value of the company. You will get the market value of the company on the basis of this model actually. Look at this. Book value of the firm plus MVA, VOE, market value of the firm that you calculated here minus market value of the debt will give you value of equity, divided by number of shares will give you price per share. So eventually we are landing to computing price per share. One question or two questions maybe, and then we are done for the day for guys. You can go and study something else, not a problem. So quick it was actually. Question number 7. Consider a firm with the following capital structure: net worth 500 lakhs, 15% KD, again be careful, you have to calculate KC, long term debt. The firm is subject to tax rate of 14, cost of equity is 17. For the next year, this is what is so important, is expected to generate, and that means it is not EBIT, it is EBIT 1. Okay, 250 lakhs, compute EVA. Okay, and find out the intrinsic value of the stock. What will you do? You will first calculate EVA. Okay, and then assuming EVA to be perpetual, no growth model. So EVA 1 by KC. What you get will be MVA. Add that to book value. What is the book value of the company? 1000 lakhs. Why? 500 lakhs is net worth, 500 is debt. Okay, start here. Look at this. They computed this 13%. If EVA is perpetual, EVA 1 by KC. Guys, it was projected EBIT. So you will not apply 1 plus GC growth rate. Okay, so they have calculated here and we get 20 lakhs. 20 lakhs by, you get MVA. Value of the firm 1000 plus 153, you get this. Then you remove 500, divide by the number of shares, you get price. You are sorted guys. I don't think we should be like, I just go ahead now quickly. Then again EVA 1 by KC, because if they say if EVA grows by 5% per annum, then again same formula, compute naturally. If it grows, then 75 is greater than 65.385. It is simple. One more last question for the day. This is an examination question actually. Fragrance Limited has reported a net operating profit, no PAT. If they say no PAT, it has to be net operating profit after tax, that means EBIT 1 minus T, to capital employed as 2.5% plus weighted average cost of capital for the year 31st March 2021. Economic value added is 4 crore as on 31st March 2021. You are required to calculate the amount of capital employed. This is the easy guys. Can you not solve this question? It's a back calculation sum. All of you, quickly. It is a back calculation sum. Did you not understand this part? Understood. You solve this. You can solve on your own. But do write this sum. This sum is important. See, the questions that I have taken in this sheet are last 2 years questions only, from RTP, MTP and everywhere. Whichever question was a bit like different. I did not include the sums which were repetitive actually in the past. So you can solve this. Can you not solve this guys? They are saying that Fragrance Limited has reported a net operating profit, no PAT to capital employed. Okay. Again, it is like very, very normal. I mean, why do we have to confuse? So WACC plus 0.025 into capital employed, okay, will give you the value of the no PAT and all. Understood all of you guys? You can do it. Yes, it is. You can solve it. It is a normal like back calculation sum. I'm not getting into the calculation. I'm more interested. Quickly, I help you revise and move ahead. If you have a doubt, still you have a doubt, we can like manage. So thank you so much. Half of the sheet is over. Remaining half we can do tomorrow. Please go and have your dinner. Please go and study well. We could save 1 hour time. You guys were quite patient and very, very very peaceful batch actually. I really appreciate. Very, very peaceful, and we could go so smooth. I'm really happy. Correct? Please revise your portions. We could finish off 1 hour early. You can eat your food comfortably. You can relax. Relaxation is important. Don't use your mobile too much. Okay? Relax. That is very important. Okay. Bye-bye everybody. Meeting tomorrow again at 7 o'clock. Link. Okay. That I'll give you again. I will give you again. Okay, given the link. Got the link, all of you? Yeah, thank you. Thank you so much, Viru. Thank you for the concern. Yeah, good night. Bye bye. I was just trying to post that link actually. Thank you so much. Good night, everybody.